Today's Wall Street Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from Journal, AI agents join social network. It's just one guy at home, and suddenly the world is emailing him like he's a customer support department. That's the whole story in one image. The modern software creator pulled out of hobby mode and shoved into infrastructure mode by virality. This is the Wall Street Journal describing what happens when AI stops being something you talk about and starts being something that acts. The article centers on OpenClaw and the social network forum called Moltbook, an online place meant to be used exclusively by AI agents. Let that sink in. Not a network for people with AI assistants, a network for the assistants themselves. And when you hear that, your instincts should split in two directions at once. One direction says, this is the future of software interfaces. Delegation, automation, agents. The other direction says, this is a safety nightmare. Autonomy, permissions, and unpredictable methods. And the point of a value investing lens is to hold both truths without flinching. Because incentives don't care how we feel about the future. They care what works, what scales, and what gets people hurt. Now, the central figure, Peter Steinberger, an Austrian coder. And the article makes him concrete in a way I love. He grew up on an Austrian farm. He spent over a decade building a prior startup, software that made PDFs easier to use in apps outside of Adobe Acrobat. He bootstrapped it. He sold it for over $100 million in 2021. Then, he disappears. He takes a few years off to relax, party with friends, travel. He says he really didn't use his computer at all. And then, like a lot of builders, AI lures him back. Last spring, as the biggest AI companies started launching coding tools, he came back online. He experimented with Anthropic's Claude Code and OpenAI's Codex. And he gets floored by how much he can do quickly. He describes it in the most builder way possible. This stuff, it's like crack cocaine for builders. That line is a tell. It tells you why this wave is different. It compresses the distance between imagination and implementation. And when that distance compresses, the number of people who can ship weird, powerful things explodes. Now we get the inflection point. Steinberger creates what becomes OpenClaw as a weekend open-source project late last year. He says he was just playing with AI and building little things for fun. Open-source approach, freely distributed, anyone can help create and modify it. And with OpenClaw, users can command and interact with personalized AI agents through messaging apps, iMessage, WhatsApp, Slack, Signal, to perform real tasks. This is critical because distribution is baked into the workflow. He didn't build another app you have to open. He built an agent you can talk to in the places you already live. That's the wedge. Now, the Moltbook piece. Steinberger views Moltbook more as performance art, designed to create conversation. It's amazing, he says. It's the intersection between AI and art. So he's not describing it as a product roadmap. He's describing it as a provocation, a window. And he's explicit. He built OpenClaw as his personal playground and never meant for it to be used by the masses. This was not intended for your mom, he says. This is a window to the future. And that's where the story flips from creator joy to allocator responsibility. Because the world doesn't care what you intended. The world cares what your tool enables. In recent days, he says the biggest AI labs and investors have reached out expressing interest in working together. As of early last week, he was in San Francisco taking meetings. He's inundated with emails and queries from users around the world asking him to troubleshoot or manage issues related to their use of the bot. And he says something that captures the scale mismatch perfectly. People assume it's a large company where they can get customer support, but it's just one guy, him, at home doing this. Virality is a form of unplanned distribution. It's also unplanned liability. So what does he do? He changes the goal. Now his goal is to make it a safe project for the masses. The next step is to make it into something that my mom can actually use. That is the moment where a builder becomes a steward. Now let's do the decision autopsy through the lens of incentives and risk. The open source approach attracts contributors, speed, and experimentation. But it also attracts adversaries and complexity. And the article says security researchers agree the product wasn't built for hobbyists. For OpenClaw to work as a true personal assistant, it has to have access to all a user's data. That's the deal. That's the trade. Access is capability. Capability is risk. For hardcore techies who know how to lock down systems and information, it can function well. But these AI agents can act autonomously on behalf of humans and keep working relentlessly on tasks with unexpected or unconventional methods. That phrase is doing a lot of work. Unexpected or unconventional methods is how accidents happen. It's also how bad actors exploit the edges. Researchers say bad actors may find ways to take advantage of them. Steinberger points to a security document he wrote, stating in bold, "There is no perfectly secure setup." And he appreciates the security research community's work. But he also says the platform was meant for tech enthusiasts who can understand inherent risks. Then he does the only rational move if you want compounding to continue. He starts spending on security. He brings on a security researcher. He says they are leveling up security, getting there, and people need to give him a few days. That's capital allocation in early stage form. Not ads, not growth, not PR. Security, because without trust, agents become a scandal generator, not a platform. Now, a detail from the article that shows you what agents doing chores really looks like. A user asked his agent to make a restaurant reservation. When OpenTable didn't work, the agent turned to a free AI voice generator tool called the Restaurant and completed the booking. That is both impressive and unsettling. Impressive because it shows tool chaining and persistence. Unsettling because it shows autonomy crossing mediums, web to voice, and it hints at how quickly agents can begin to impersonate, misrepresent, or simply confuse humans on the other side. Now, the hype layer shows up, as it always does. Some industry insiders ask whether this phenomenon is evidence of artificial general intelligence. Steinberger doesn't think so. AGI is not here yet, he says. Maybe in 10 years. So the article is pushing against the tendency to turn every viral moment into a metaphysical conclusion. It's saying, this is powerful automation, not magic. But hype arrives anyway. Elon Musk described the Moltbot moment as the very early stages of singularity. And you should hear that as narrative fuel, not a product requirement. Now, trademarks. This part matters because it shows how the ecosystem disciplines newcomers. Steinberger initially named the enterprise Claudebot. Anthropic reached out, requesting he change the name because it was too similar to Claude. He changed it to Moltbot, but it didn't quite catch. Then, after calling OpenAI's Sam Altman to ensure he wouldn't cross trademark infringement, he changed the name to OpenClaw. He writes in a blog post, "The lobster has molted into its final form." This is the mundane constraint behind the futurism. You still have to navigate branding, IP, and the reality that the big labs are building empires, not just models. Now, visuals. On screen, viewers will see a Reuters photo captioned around the idea that the forum called Moltbook is meant to be used exclusively by AI agents. You have to make people picture this. A social feed where the users are not humans posting selfies or opinions, but bots posting tasks, outputs, links, and requests to other bots. That's the new network effect. Agent-to-agent interoperability. And the hidden message is, the customer might not be a person anymore. It might be software buying software. Now, the reality check, because this is where value investors separate signal from novelty. A viral open-source agent platform can become a durable ecosystem, but it can also collapse under 3 weights. 1. Security incidents. 2. Trust and reputational blowback. 3. Operational burden. Support, compliance, uptime, when the maker is still one guy at home. Steinberger is moving toward the adult version of this project. Safe enough for normal people, but the transition from enthusiast tool to mainstream infrastructure is where most projects die, because the requirements change completely. Now, 3 lessons to take away. Lesson 1. Distribution beats perfection early, but security beats distribution later. The moment your tool touches real tasks and real data, you're not shipping features, you're shipping responsibility. Lesson 2. Autonomy is the new UX, and it changes the unit of value. The agent is paid for outcomes, not clicks, that shifts incentives for product design, pricing, and retention. Lesson 3. Compounding in tools comes from integration, not virality. Messaging apps, task execution, interoperability. Those are the rails. Moving to next title, many factors plague current labor market. The labor market can look fine in the headline numbers and still be quietly breaking underneath. That's what I take from this Wall Street Journal piece. Because the story here isn't layoffs, it's hiring. It's churn. It's the oxygen of opportunity. People leaving, people getting replaced, new entrants getting absorbed. And the article's core claim is blunt. The pace of hiring in America has dropped precipitously, and there isn't a single reason why. There are a lot of them. Now, start with the psychological data, because psychology is often the leading indicator. Consumers surveyed by the New York Fed put their chances of finding new work in the next 3 months, if they lost their job, at 43%. That's the lowest level on record in the dozen years the bank has been asking. University of Michigan's preliminary February consumer survey says 60% of respondents expect unemployment to rise over the next 12 months. The Conference Board survey shows a sharp rise in the share of people who say jobs are hard to find and a drop in those who say jobs are plentiful. That mix, low perceived mobility, rising fear, changes behavior. And behavior changes the economy. This is where incentives begin. When people feel trapped, they stop quitting. When they stop quitting, employers stop replacing. When employers stop replacing, the hiring market freezes. And the journal gives you that feedback loop explicitly. J.P. Morgan Chase economist Mike Ferroli says, people are sticking around in their jobs, and because of that, you don't need to do as much replacement hiring. Then he describes the adverse feedback loop. People don't want to quit because the pace of hiring is low, but part of why hiring is low is that nobody is quitting. That's the frozen lake. It looks stable, but it's not healthy. Now put numbers on it, because numbers are where we stop hand-waving. First, tariff policy uncertainty. Companies can't plan ahead, so they hold off on hiring. Small businesses get hit harder because tariffs raise costs and make it harder to take on new employees. Second, high short-term interest rates. Smaller firms rely on credit card borrowing to meet financing needs, and higher rates squeeze them. Third, tech overhang. Tech companies that hired heavily after the pandemic are still dealing with an overhang of workers. Fourth, the supply of workers itself. The article says President Trump's crackdown on immigration has severely restricted the flow of people into the U.S. Coupled with an aging country, there are fewer new entrants into the workforce. And then you get one of the more subtle, second-order points in the piece. Stan Vuger says immigration restrictions don't just reduce the number of workers employers can hire. They reduce how many workers employers need to hire, because immigrants aren't just workers, they're consumers too. It's both supply and demand. This is how economies really work. Every labor policy is also a demand policy. Now we have to address the AI question, because it's in the background of everything right now. The article says sorting through AI's effect on the job market has been challenging. Some analysts point to stalling tech employment starting in November 2022, around when ChatGPT launched, as a sign AI is cutting into hiring. But the journal cautions there was a wave of tech layoff announcements in November 2022 because companies realized the post-pandemic surge wasn't going to persist. AI wasn't in the mix. Still, there is some evidence AI is having an effect. A Stanford analysis by economists Eric Brynjolfsson, Bharat Chandar, and Ruyu Chen finds young people's employment prospects in jobs highly exposed to AI-like software development have been hurt. But Brynjolfsson says in the context of about 160 million employed Americans, it's not enough to move the aggregate market yet. That's a very investable framing. AI can be devastating locally before it shows up nationally. It hits cohorts, it hits entry level, it hits specific job families, and the aggregate doesn't flinch until it does. Now, let's align narration with what's on screen. On screen, there's a line chart labeled Hires Rate, showing December at 3.3%, with a timeline running from 22.2 through 22.2, and the rate plotted from roughly 2.5% to 5%. The point is not just that it's low. The point is that it fell from a hot, high-churn labor market to a cold, low-churn market. Then there's another visual, a bar-style view of the share of consumers who say jobs are hard to get versus plentiful. Hard to get is 20.8%. Plentiful is 23.9%. That narrow gap is what anxiety feels like in data. It's not despair, it's fragility. Now, reality check. What does this mean for investors? It means the economy can chug along, as Ferroli says, without producing the kind of job market dynamism that supports broad-based optimism. It also means corporate behavior will shift. If hiring is hard to justify and workers aren't quitting, firms will try to do more with the headcount they already have. Automation, productivity tools, and process redesign. That can boost margins in some sectors, but it can also suppress wage growth and weaken consumer momentum in others. And it means you should be careful with simplistic narratives like low unemployment equals strong labor market. Sometimes, low unemployment is just low motion. Now, lessons. Lesson 1. Watch churn, not just level. Unemployment is a level. Hires and quits are motion. Motion tells you whether the system is healthy. Lesson 2. Policy uncertainty taxes planning. Tariffs and rates don't just change costs, they change confidence, and confidence changes hiring. Lesson 3. Demographic and immigration shifts don't just change the labor supply. They change the demand base too. That's the second-order effect that makes forecasting harder than it looks. And I'll end with one sentence that captures the piece's core idea. A labor market doesn't have to be collapsing to be stuck. And stuck is its own kind of risk. Moving to next title, Officials' Families Cash In. The most important sentence in this Wall Street Journal piece is not about crypto. It's about plumbing. It says the co-founders of World Liberty Financial created a system where cash flows back to them directly, skipping other owners of WLFI coins and later investors. That's not a vibe. That's a design. And as value investors, we live and die by designs. Because design is incentives made tangible. Everything else is story. Now, step back. This isn't a story about one token. It's a story about how modern financial celebrity gets manufactured. How political proximity, distribution, and a hot speculative sector can compress a decade of wealth creation into a few quarters. And how the difference between building a business and extracting cash can be hidden inside terms, lockups, and deal structure. So let's walk it. The article is about the offspring of Trump administration officials who have become wealthy financial celebrities. And it says crypto is the key accelerant. Businesses that raised billions from investors. And because they were able to extract real cash quickly, they're far less exposed to the current crypto downturn than retail investors who loaded up on digital tokens. That's the first split in the story. Founders and insiders monetize early. Late buyers hold the bag. Now, central figures. Zach Witkoff is one. The Trump sons are the other. And the supporting cast matters because it tells you how these systems get built. Witkoff studied business administration at the University of Miami's Herbert Business School. He worked as a project manager at his father's property firm, the Witkoff Group. Then he co-led the family's personal investment firm, Witkoff Capital. A spokesman says he helped oversee over $1 billion in capital and billions more in real estate. He has known the Trump sons since he was little. There's social proximity here, not just transactional proximity. The article notes Trump and Melania were guests of honor at Witkoff's wedding at Mar-a-Lago, and Witkoff later named his first child after Trump. These are deep relational signals. Then the emotional hinge. Witkoff says he saw Eric and Don Jr. looking downtrodden. They told him that after criminal and civil actions against their father and his companies, they were scrambling to find banks that would accept them as clients. And here's where incentive meets opportunity. If the traditional financial system says no, you either retreat or you build a parallel system. Crypto is a parallel system. Sometimes it's a genuine innovation, sometimes it's an escape hatch. Often it's both. Now the band of brothers. Witkoff had befriended two internet marketers dabbling in crypto and suggested a meetup. Zach Folkman, who created a website called Date Hotter Girls. Chase Harrow, who once described himself as a dirtbag of the internet. They were running a small crypto project that they later shut down because it got hacked. They all sit down in the Mar-a-Lago conference room and hatch a plan for a crypto venture. Witkoff says, "We just became like a band of brothers." This is how most ventures start. Small rooms, shared grievances, and a story that feels like destiny. But the compounding question is always the same. Is the product real, or is the structure real? Now the inflection point. Donald Trump himself. The article says Trump's involvement with World Liberty marked an about-face from his earlier public stance that Bitcoin was a scam. And it says he completed his conversion in July 2024 after a gusher of campaign donations from the digital currency industry, when he said he would be a pro-Bitcoin president at a Nashville crypto conference. So incentives shift. Money shows up, position changes. Then World Liberty launches that October. It names the senior Trump its chief crypto advocate, though now he is listed as co-founder emeritus. It begins selling WLFI, a governance token, vote rights in some operations, And World Liberty publishes a document advertising WLFI as pioneering a new era of decentralized finance and democratizing access to financial opportunities. That language is important. Democratize access is the classic wrapper. Now let's do capital allocation and decision autopsy, because this is where the article gets surgical. World Liberty, the journal says, has doled out at least $1.4 billion to both families since the president's re-election, based on a journal analysis of public disclosures and private documents. Among those payouts, a secret $500 million deal to sell almost half the company to an Abu Dhabi royal and co-investors. Then the dollar numbers get even sharper. World Liberty has earned the Trump family at least $1.2 billion in cash in the 16 months since launch, not counting paper gains of at least $2.25 billion from various crypto holdings. By contrast, it took 8 years for Trump's real estate, golf, and brand empire to throw off that amount of cash between 2010 and 2017, according to Trump Organization financial statements disclosed in a New York lawsuit. And the Witkoffs earned at least $200 million from World Liberty. Pause on that comparison, because it's the entire compounding versus extraction point. Real estate and operating businesses are slow compounding machines. Sometimes they become durable businesses, but the base case is often that the cash comes first and the product comes later. Now the key deal structure. Alt 5 Sigma. The plan, according to people familiar with the proposal, was for World Liberty to take over a publicly traded firm, raise money by selling shares, and use the funds to buy World Liberty's own WLFI token. They analogize it to strategy. Shareholder money buys Bitcoin, pushes Bitcoin higher, lifts the stock in a virtuous cycle as long as Bitcoin rises. World Liberty settles on Alt 5 Sigma, a small NASDAQ-listed crypto payments firm. In August, World Liberty says it will use its tokens to buy a controlling stake in Alt 5. Alt 5 will raise $750 million from investors at $7.50 per share. Witkoff becomes Alt 5's chairman. He touts a plan. Alt 5 will incorporate World Liberty's USD1 stablecoin into its payment products. He even tells CNBC Alt 5 is an incredible company with incredible technology. Then comes the big payday section. Flush with $750 million, Alt 5 directs almost all that money into buying WLFI tokens at 20 cents apiece, 60% above a price a private investor had recently paid. Now here's the mechanism. Alt 5 didn't buy tokens on the open market. It bought them directly from World Liberty, according to Alt 5's securities filings. And the journal describes it as similar to a public company issuing new shares that dilute shareholders, but with a remunerative twist. The money goes to the original owners. Over $500 million to a Trump family-owned entity, $90 million to the Witkoff family. At the time, WLFI holders weren't able to sell because tokens were locked, so you have insiders selling to a public vehicle while other token holders are locked, and public shareholders fund the purchase. That is not compounding. That is a cash extraction loop. Now what happens next? Within 3 weeks, Alt 5's stock price begins sliding. Executives warn World Liberty that investors are already dumping shares. Alt 5 makes little progress integrating USD. The article says no USD1 transactions have ever been processed on its payment platform, based on trading data on Alt 5's website. Then management turnover. In the last 3 months of the year, Alt 5 announces departures of the CEO, acting CEO, and CFO, COO, and a board member who chaired the audit committee. By this month, investors who held from the August fundraise are down over 75%, with Alt 5 shares around $1.70. WLFI price slumps to 10 cents. Dozens of WLFI holders complain in World Liberty's public online forum that most of their tokens are still subject to lockup. Alt 5 CEO Tony Isaac issues a statement saying the company is focused on growing its WLFI treasury and payments businesses, believes it's positioned to generate long-term shareholder value, and is excited about the future and partnership. That's the official language. But the numbers are the numbers. Now, the distribution of proceeds, this is the part I want you to hold in your head like a cap table. Virtually all the money from WLFI sales goes straight to the Trumps, the Witkoffs, and their co-owners, Folkman and Harrow, not the company itself. World Liberty's disclosures. After some operating expenses, 75% goes to a Trump entity, 12.5% to a Witkoff entity, 12.5% to Folkman and Harrow. The article says the president owns 70% of that Trump entity, unnamed family members 30%. Based on financial disclosures, the Witkoff family doesn't disclose its internal breakdown. That is a waterfall built for extraction. Now, the Abu Dhabi deal. On January 16th, two lieutenants for Sheikh Tahoun bin Zayed Al Nahyan sign a deal to purchase a 49% stake in World Liberty for $500 million. Huge for a company that had no products at the time. Of the upfront installment, $187 million goes to Trump family entities, $31 million to Witkoff-affiliated entities. The deal doesn't give the Tahoun-backed entity rights to proceeds of future WLFI token sales, preserving the Trumps and Witkoff's income stream. Again, preserve the income stream. That's the North Star. 2 days later, Trump and his wife launch memecoins, Trump and Melania, via a separate partnership. Trump's Trump holding races to a multi-billion-dollar paper value, then swiftly plummets. The article notes those coins are now down 95% and 99% respectively, and says it's unclear what cash Trump received from the memecoin sale. Now, pivot. World Liberty stopped selling WLFI to the public in March. By then it says it took in $550 million from token sales, plus the UAE investment. Then it shifts into a potentially more lucrative direction, a dollar-pegged stablecoin called USD. And here, the journal explains the economic engine of stablecoins in plain terms. Stablecoins are supposed to track a real currency. They're useful for traders who want shelter from volatility. Issuers take traders' dollars and put them into assets like U.S. Treasury bills, but the issuer keeps the interest profits while traders typically make nothing. They cite Tether, the largest issuer, reporting $10 billion in profit last year from its holdings. That is the business model. It's not tech, it's spread. Now, the pigs get fat moment. In April, Zach Witkoff and Eric go to Dubai to promote USD1. U.S. Secret Service seals off the room. They announce a state-backed Emirati investment firm will use USD1 to buy a $2 billion stake in Binance. The journal says this would set World Liberty up to earn about $80 million a year from treasuries backing the stablecoin. And Witkoff says on stage, pigs get fat and hogs get slaughtered. It's almost too perfect, because the entire article is about who gets fat and who gets slaughtered inside the structure. Now, there's another parallel venture. American Bitcoin, Eric and Don Jr. build it at the same time. It merges in May with a tiny public former cannabis software firm to become a standalone public company. A slide deck shows Eric in front of an American flag with quotes, "Crypto is the future, and American Bitcoin will set the standard." In June, it raises $220 million from undisclosed investors at a valuation over $1 billion. In September, after listing, investors send market cap above $5 billion. Then another share sale raises $134 million through mid-November at an average price over $7 a share, roughly around that $5 billion valuation. Lead investment bank, Cantor Fitzgerald. And the article notes, Cantor has become a top choice for crypto deals, helping it to its best year ever with investment banking revenue soaring. But for American Bitcoin shareholders, it hasn't gone well. 2 months after listing, Bitcoin slides, and so does the stock. In early December, shares plunge further when lockups expire. American Bitcoin shares are down over 80% from the public listing. Eric still has paper gains, his shares worth around $90 million as of Friday, per securities filings. Don Jr.'s holding remains undisclosed. So again, insiders are cushioned, outsiders are exposed. Now, visuals. This article contains the kind of evidence graphics that matter. On screen, the viewer sees a system diagram. It shows 3 sources of money: stock investors, crypto buyers, and UAE investors. It shows WLF using its coins to buy control of Alt5, then Alt5 raising $750 million in cash to buy more WLFI. And it shows the split of the cash: 75% to Trump family, 12.5% to Witkoff family, 12.5% to Folkman and Harrow. This diagram is the thesis rendered as plumbing. Then on screen you see a chart for WLFI cumulative revenue, with markers like Alt5 purchase, Trump's inauguration, and the period where WLFI price falls along with the broader crypto market. You also see USD1 market capitalization over time, and notes about Binance announcing $40 million in rewards and beginning a USD1 boost program. plus a note that USD1 was used for a Binance investment. The article includes multiple denials. The administration says no conflicts, the White House says Trump has no involvement, Counsel says no involvement in business deals implicating constitutional responsibilities, and a World Liberty spokesman says there have never been conflicts of interest. World Liberty says it played no role in Zhao's pardon. Binance says neither it nor Zhao financed or helped World Liberty, and World Liberty says its Binance interactions have been routine. But here's the thing. As investors, we don't have to adjudicate motivations to evaluate structures. We just have to look at who gets paid, when they get paid, and what the buyer receives in exchange. And the structure described here heavily favors early insiders capturing real cash quickly. Now, 3 lessons, timeless ones, straight out of this. Lesson 1. Follow the cash flow, not the narrative. When founders get paid directly and early, you are not financing compounding. You are financing extraction. Lesson 2. Lockups create asymmetry. If one group can sell into a structure while others can't, price is not discovery, it's transfer. Lesson 3. Stablecoins are not a meme. They are a spread business dressed as fintech, and if they scale, they throw off real cash in a way memecoins never will. And I'll end with the sentence I want you to remember for years, because it's the investor's North Star in markets like this. In speculative cycles, the product is optional, but the payout terms are the business. Moving to next title, Crypto Bulls Struggle to Explain Latest Skid. Bitcoin just had its largest weekly decline in more than 3 years. And the strangest part, if you've been around markets long enough to be numb to volatility, is that even the true believers don't seem to know why. That's the psychological tell. When a market is healthy, it has a narrative that matches the tape. When a market is fragile, the tape moves first, and everyone runs around after it, grabbing whatever explanation fits in their hand. This is the Wall Street Journal putting a spotlight on that exact moment in crypto. The story is not just the drop. The story is the confusion. The story is the realization that the always up and to the right era, where every dip had an obvious villain and every rally had an obvious hero, can disappear overnight. Now, start with the hard numbers, because numbers are where the denial ends. Bitcoin fell 16% last week to $70,008. It is down 45% from its all-time high of $126,273 in October. Ether dropped 24% to $2,052, down 59% from its own high last year. Both staged furious rallies on Friday. But the week was still historically bad, and in markets, when you're down 45% from a high, your first job is not to predict the next 10%. Your first job is to understand what you actually own. And what you own in Bitcoin is not a cash flow stream. It's not a business. It's not a bond. It's an asset whose primary driver is belief, liquidity, and positioning. That doesn't make it worthless, but it makes it different. And when you treat different like safe, you end up shocked by the very thing you bought. Now, the central figures in this article are not CEOs. They're what I'd call crypto's narrators. The luminaries who are so well known they go by one-name nicknames: Pomp, Novo, Mooch. And when the journal says these people were searching for answers, what it's really saying is, the narrative engine stalled. Anthony Pompliano writes on Friday, Bitcoin is crashing and investors are freaking out. Michael Novogratz, who runs Galaxy Digital, a crypto merchant banking and trading firm, says, there was no smoking gun. No smoking gun. That's important, because when there's no smoking gun, you're forced to confront the truth that markets don't need a reason to fall. Sometimes they fall because the marginal buyer disappears. Sometimes they fall because positioning gets too crowded. Sometimes they fall because everybody wanted the same trade for the same reason at the same time. And when that happens, the exit door doesn't get bigger just because the market cap is big. Now, the inflection point in the piece is this contrast. For much of last year, crypto was in ascendance. Bitcoin and other popular tokens touched record highs. It seemed as though the market's best days always lay ahead. Then you get this line from Corey Clipston, CEO of Swan Bitcoin, a Bitcoin financial services firm. He says, I really didn't think that we'd see a 6 at the beginning of the Bitcoin price ever again, meaning a price in the 60,000s. And yet, for a 24-hour stretch that ended Friday afternoon, Bitcoin was back at that level. That line is pure investor psychology. It's not analysis. It's anchoring. It's the moment you realize that your internal range of outcomes was too narrow, that you started treating a high watermark like a floor. that you confused a bull market for a new law of physics. And I want to sit here for a second, because that's the repeating pattern. It happens in every mania: stocks, housing, commodities, crypto. At the peak, people stop saying could. They start saying would never go back below, would never be allowed to fall, would never be valued that cheaply again. And the market loves punishing the word never. Now, what are the theories for the sell-off? The journal lists them, but it's careful to call them theories. One theory: investors pivoting toward prediction markets and other risky bets. Another theory: widespread profit-taking after a blistering bull run. And then it circles back to the core: few seem to know what went wrong. That uncertainty is itself a form of risk, because in narrative-driven assets, clarity attracts capital. Confusion repels it. Now, there's another layer here that matters for incentives. The article says President Trump's return to the White House ushered in a new era for digital assets, which continued to gain acceptance among individual investors and legitimacy on Wall Street. Legitimacy is a double-edged sword. It expands the buyer base. It also expands the set of players who can short, hedge, arbitrage, and trade these assets like any other risk-on instrument. The moment you become Wall Street legitimate, you become a component in portfolios, not a religion. And components get cut when risk budgets shrink. Now I want to obey your visual rule. On screen, the viewer sees a chart labeled Bitcoin Price Performance, past 2 years, sourced to CoinDesk. It's a line that rises into the euphoric zone and then snaps down into the kind of drawdown that forces a repricing of certainty. The viewer also sees key political and policy markers in that same visual environment. Things like Trump being elected, Trump signing the Genius Act into law, and a surprise announcement of 100% tariffs against China. Those labels are doing something subtle. They're implying that Bitcoin's recent regime was tied to a broader macro narrative: policy shifts, political signals, and risk appetite. But the chart also teaches the opposite lesson. Even with catalysts, the asset remains violent. It does not glide. It lurches. Now, reality check. If you're a value investor listening to this, you're probably thinking, this doesn't sound investable. And that's fine, because the point isn't to convert you. The point is to see the structure clearly. Crypto's permabulls are puzzled because they're trying to map a business world causality framework onto a market that can move on flows and sentiment. That's not an insult. It's just a category error. A business compounds when it reinvests cash at high rates. Bitcoin doesn't reinvest. It reprices. So what does that mean for decision-making? It means the decision is not, is Bitcoin good or bad? The decision is, what role does this play in a portfolio? And what size can you hold without lying to yourself about volatility? Because a 45% drawdown is not a tail event here. It's part of the product. Now, 3 lessons I'd extract. Lesson 1. When the story gets too easy, risk is building. When everyone believes the best days always lie ahead, you don't have a market, you have a one-way bet. Lesson 2. In narrative assets, the absence of a smoking gun is the warning sign. It means the move wasn't about news. It was about positioning and psychology. Lesson 3. Legitimacy doesn't remove volatility, it professionalizes it. More participants means more strategies, more leverage, more correlation, and sharper unwinds. And I'll end with a sentence that's worth carrying into every speculative corner of markets. When nobody can explain the drop is the explanation. Moving to next title, Crypto Dive has fans puzzled. If you ask 5 experts, you'll get 5 explanations. That line is doing more work than it seems, because it tells you the real condition of the market. It's not just down, it's directionless. And when a market is directionless, the people who survive are not the ones with the loudest conviction. They're the ones who understand positioning, liquidity, and incentives. This is the Wall Street Journal continuing the same theme. Bitcoin's big weekly slide left the faithful puzzled. And the puzzle matters because crypto people usually have a clean narrative for every move. This time, the journal says, there is no clear consensus. Anthony Scaramucci? Yes. The same Scaramucci who served 11 days as communications director during Trump's first term and now is a well-known crypto bull at Skybridge Capital, says it plainly. Ask 5 experts, get 5 explanations. And then the article does something valuable. It lays out the most popular explanations not as truth, but as competing frameworks. And I want to treat each one like a case study in what markets do when they run out of certainty. First explanation: new shiny objects. Pompliano, here described as the CEO of ProCap Financial, says there is no shortage of other markets for traders to make audacious bets. Prediction markets, gold, silver, artificial intelligence, so-called meme stocks. They're all competing for attention, pulling eyes away from crypto. Pompliano frames it as a shift in where asymmetry lives. He says Bitcoin used to be the consensus view where asymmetry existed. Now there are many places people can speculate. This is a deep point, and it's not even specifically about Bitcoin. In every speculative era, the marginal gambler is not loyal. They are yield-seeking, volatility-seeking, narrative-seeking. If you're an asset whose main input is attention, you're always one new shiny object away from outflows. Second explanation. More supply. Sort of. This is subtle. The article says Wall Street has sought to capitalize on crypto's popularity by launching a growing array of exchange-traded funds and derivatives linked to Bitcoin and other tokens. This doesn't change the number of Bitcoins, but it might change the experience of scarcity. Bitcoin's main appeal has always been its limited supply, 21 million coins. Yet by creating ETFs and complex derivatives, Wall Street enables investors to bet on Bitcoin's price without buying or holding the actual coins. And some analysts think that dents Bitcoin's appeal as a scarce asset. Now, pause. You can argue about whether that's true in a philosophical sense. But markets don't price philosophy. Markets price flows. If a meaningful portion of demand can now be satisfied through wrappers, ETFs, swaps, options, then the demand pressure on the spot coins can change. Scarcity in practice becomes scarcity of exposure vehicles, not just scarcity of the underlying. And that's a big shift. It's the difference between owning the thing and owning a claim on the thing. And once you introduce claims, you introduce leverage, hedging, and synthetic supply of exposure. Third explanation, new sheriff. Some investors suspect Kevin Warsh, Trump's pick to be the next chair of the Federal Reserve, might be bringing down crypto prices. Why? Because Warsh is seen as more hawkish on interest rates as a tool to tame inflation and more supportive of a stronger U.S. dollar. Higher rates and a stronger dollar typically hurt some alternative assets like gold and crypto, making them less attractive. And the journal gives you the data point. Last week, the WSJ dollar index edged up 0.4. Then it complicates the story. Warsh and the Fed are expected to cut rates this year, not raise them. And Warsh has warmed to Bitcoin. He once dubbed it a policeman for policy, suggesting Bitcoin's price can inform policymakers when they're doing things right and wrong. So even the new sheriff theory is internally conflicted. It's not clean. It's not a smoking gun. It's another narrative people grab because it fits the macro template. Dollar up, risk assets down. Fourth explanation, clouded clarity, regulation as a missing catalyst. After Trump signed the Genius Act into law last year, the industry turned attention to the next big bill, the Clarity Act. That bill would create a clear regulatory framework. Congress seemed close to moving it ahead. Then a dispute between crypto exchanges and traditional banks stalled momentum. Without the measure, many financial firms are hesitant to integrate digital assets into their offerings. And unless compromise is reached, the dust-up could deny the crypto market a catalyst that might have extended the rally. This is how mature capital behaves. Big firms don't need excitement. They need rules. They need permission. They need stable compliance pathways. So when regulation stalls, institutional adoption becomes a slogan instead of a flow. Fifth explanation. Novogratz and others think much of the sell-off was driven by investors eager to lock in gains from the rally that accompanied the euphoria of Trump's election in 2024 and the pledge to make the U.S. the world's crypto capital. The journal says those gains were spectacular. Bitcoin rocketed around 80% from election day until early October of last year. When you've just done 80%, you don't need a scandal for a sharp move down. You just need enough people deciding it's time to be paid. Now, the journal places this sell-off in context, and this is where pattern recognition matters. In 2018, Bitcoin fell 80% after the initial coin offering bubble burst, an era when thousands of unproven startups raised billions on little more than a sales pitch. In 2022, the collapse of Terra USD and Luna, $40 billion, triggered cascading failures that culminated in the implosion of Sam Bankman-Fried's FTX exchange. Those were crises with villains and plot lines. This time, the journal implies, there's no comparable signature scandal. No key companies have collapsed. No allegations or revelations that create a crisis of confidence. So some analysts think this crypto winter could thaw faster than those of the past, and believers point to Friday's rally as reassurance. Cryptocurrencies have always bounced back, which is why they stick with these investments. Jasper Demer, a strategist at crypto trading firm Wintermute, says the infrastructure is stronger, stablecoin adoption continues to grow, and institutional interest hasn't evaporated. It's just sidelined. That's an optimistic framing, but it's also a revealing one. It suggests the next leg up is not about memes. It's about plumbing, stablecoins, rails, institutions. Now we get an explicit time horizon sermon. Strategy founder Michael Saylor, whose company stockpiles Bitcoin, tries to reassure investors on a Thursday afternoon conference call. His company reports a $12 billion quarterly loss related to the token's late 2025 swoon. And Saylor says the only way to handle the downturn is to hold on and tune out the volatility. He says your time horizon needs to be minimal 4 years. This is the classic move in narrative assets. When you can't promise path, you promise horizon. And sometimes that's wise. But as investors, we have to ask a sharper question. Is 4 years a strategy, or is 4 years a coping mechanism? Because in businesses, a 4-year horizon is where you can underwrite reinvestment cycles, product cycles, pricing power. In Bitcoin, a 4-year horizon is tied to belief in cyclical flows, liquidity cycles, adoption waves, policy cycles. That's not wrong. It's just a different kind of underwriting. Now, visuals. On screen, you're still seeing that Bitcoin 2-year chart. But now, as the story evolves, that chart becomes less about a single crash and more about a timeline of narratives. When the chart hits record highs, that's the legitimacy era. When it collapses, that's the who knows why era. The visual teaches the real lesson. Crypto is a market where volatility is not a bug. It's a feature that clears leverage, tests conviction, and transfers coins from weak hands to strong hands, or from late buyers to early sellers, depending on where you sit. Now, the reality check. This article is not saying crypto is dead. It's saying the easy confidence is dead. It's saying the market is searching for the next dominant narrative. And while it searches, price can do anything. That's why these moments are dangerous. Not because the asset is going to zero tomorrow, but because when the narrative is missing, any narrative can take over. And the loudest narrative usually wins for a while, until it doesn't. Now, 3 lessons I take away. First, catalysts matter more in assets without cash flow. If your asset doesn't produce cash, price needs stories and flows. Regulatory clarity, institutional integration, macro tailwinds. Those are not side quests. They are the core. Second, scarcity is not just supply, it's market structure. ETFs and derivatives change how demand expresses itself, and that can change price dynamics even if the coin count never changes. Third, time horizon is not a substitute for analysis. A 4-year holding period can be wise, but only if you understand what you're betting on: liquidity and adoption cycles, not business compound. Moving to next title, Washington Post publisher Lewis exits. The data tells us what is valuable and where to focus. That's the line. That's the whole moment captured in one sentence. Because when a company starts talking like that, when the owner is talking like that, it's telling you the business has changed. Not cosmetically, structurally. This is the Wall Street Journal looking at the Washington Post and watching the old prestige model collide with the new distribution reality. The Post's publisher, Will Lewis, is leaving the role days after the company announced it was laying off 1/3 of its staff. And immediately, the Post names its finance chief, Jeff D'Onofrio, as acting publisher and CEO, effective immediately. So let's treat this like investors, like operators. We strip away the emotion. We look at roles, incentives, and the sequence of decisions. Because in a turnaround, sequence is everything. The central figure first, Will Lewis. The Journal says he is departing after 2 tumultuous years atop the organization. He arrived with a mandate: carry out a digital transformation, stem financial losses, reverse a decline in online readership. Those aren't editorial goals. Those are business goals. And when you take an institution like the Post, an institution that historically sold authority, and you force it into a performance-driven digital market, you create an internal tension that doesn't go away with good intentions. Lewis was previously CEO of Dow Jones, the Wall Street Journal's parent company. And at the Post, he laid out a plan to build a third newsroom for social media and service journalism, separate from the core news operation and the opinion section. That phrase, third newsroom, is a very specific kind of capital allocation. It's saying, we are going to allocate talent, time, and money into a unit built for distribution-first content. It's a bet that the company can do two things at once: protect the legacy product and manufacture a new product that plays the internet game. Now, why does this moment matter? Because the old media compounding flywheel, reporting builds reputation, reputation builds subscribers, subscribers fund more reporting, has been interrupted by platform dependence. And when the flywheel breaks, you start managing by triage, by focus, by cutting, by narrowing the mission. The Journal anchors the timing. Lewis became CEO and publisher in early 2004, soon after Jeff Bezos told the newsroom he wanted the paper to return to profitability. That's the owner setting the constraint. It becomes the boundary conditions for every decision after that. Bezos said Lewis's background in award-winning journalism made him the right choice to lead. But the Journal also notes Lewis was dogged later that year, as legal proceedings played out in the UK, by criticism of his work for News Corp more than a decade earlier during fallout from a phone hacking scandal. Whether or not that was fair, that's reputational drag in an organization whose output is trust. Now, here's an operational point in the sequence. The Post lost a wave of subscribers in late 2024 after announcing it wouldn't be endorsing any candidate for that year's presidential election. Subscriptions are the cash flow. A wave of subscriber losses is the market voting in real time on a strategic choice, so your revenue base is telling you something. Then, the opinion section gets narrowed, early last year, to focus on supporting and defending personal liberties and free markets. That's repositioning. That's choosing a lane. And in media, choosing a lane is not just editorial, it's product strategy. It's who is the customer, what do they come here for, and what will they tolerate? Now the cuts. On Wednesday, the Post said it would close its sports department in its current form, restructure its Metro section, eliminate its book section, and pare back international coverage, among other changes. And it plans to focus primarily on national news and features, investigations, and advice on health and wellness topics. Read that again. That's a portfolio shift. You're shrinking breadth, keeping the high-prestige, high-impact categories, national, investigations, while adding or emphasizing service categories like health and wellness that can be sticky, searchable, and monetizable. This is the inflection point. The modern newspaper becomes a barbell. On one side, investigations and national power coverage. On the other side, advice and service content. And the middle expensive breadth that doesn't convert gets cut. Now the new central figure, Jeff D'Onofrio. He joined in June as finance chief and is now acting publisher and CEO. His background, per the Journal, finance chief at digital ad company Raptive and CEO of Tumblr. That's internet economics and platform thinking. And that tells you what the owner wants to optimize. Now bring in Matt Murray, executive editor, previously editor-in-chief of the Journal. He says the cuts will allow the company to be more flexible and provide readers with more relevant content. That's the internal logic. Focus equals relevance. But the phrase that matters, the one that signals the operating system, is Bezos's statement, each and every day readers give a roadmap to success. The data tells what is valuable and where to focus. On screen, you're seeing the same language as text, and you can feel the incentive shift. Incentives move from editorial judgment is the product to customer data is the steering wheel. Now, D'Onofrio echoes it in his letter. He says he looks forward to leading into a sustainable, successful future with the strength of the journalism as the North Star. And he says decisions will be driven by customer data, sharpening the edge in delivering what is most valuable to audiences. Same operating system, same vocabulary. North Star plus metrics. Now, Lewis's exit. He says in a note to staff that after 2 years of transformation, now is the right time to step aside. He says difficult decisions were taken to ensure the sustainable future. He didn't immediately respond to a request for comment Saturday night, the Journal notes. And then the Journal zooms out to the industry reality that makes this not just a Post story. Many publications, large and small, are grappling with shifting reader habits. They're dealing with a decline in traffic from tech giants. And they're staring at generative AI tools that are changing how people search for and consume information online. This is the new distribution constraint. In the old world, you fought for the front page. In the new world, you fight to be the answer. Or you fight to be the source that the answer cites. And that fight is brutal, because the platform that sends traffic can also decide not to. Now we get the human organizational reality. Post staffers criticized Lewis and Bezos for not being involved in communicating last week's job cuts. Journalists said publicly that Lewis didn't engage with the newsroom regularly for most of his tenure. And Murray says on Puck's The Grill Room podcast that the Post has been battered around for years and had a lot of challenges, and that cost and structure issues had built up over years and were more deeply problematic than he and Lewis knew. That's a key admission. It says the model's weakness wasn't created in the last quarter. It was latent, accumulated, and then forced into the open by a distribution regime change. Now, Lewis's background matters because it signals the kind of leader this moment selects for. Before becoming an executive, he was a reporter and editor, including at the Financial Times. He joined News Corp's business side in 2010. During his time as CEO, he increased the journal's digital subscribers. In 2020, he co-founded a media startup, The News Movement, making content for TikTok, Instagram, and YouTube. So his career arc is basically the arc of media itself, from newsroom craft to subscriber business to platform-native content. And still, he leaves after 2 tumultuous years. Which tells you something uncomfortable. Competence doesn't guarantee turnaround when the underlying economics are shifting under your feet. Now, the decision autopsy as investors would do it. What was expected? A digital transformation, a stemmed loss profile, a stabilized, perhaps growing online readership. What actually happened? A 1/3 staff layoff, a leadership exit, a reset to focus primarily on fewer categories, and a clear, explicit move to data-driven decisions. Opportunity cost? Every newsroom dollar spent on a third newsroom is a dollar not spent on core reporting. Every bet on social and service content is a bet away from breadth. Hidden trade-offs? When you optimize for what readers value as measured by data, you can drift toward what is immediately consumed, not what is civically important. But if you don't optimize for consumption at all, you can end up with a beautiful product that can't pay for itself. This is the trap. Most failures come from success carried too far. In media, the success was authority. The failure is believing authority alone guarantees distribution. Now, the reality check. The Post is not alone. Traffic from tech giants can decline. AI can intercept search behavior. Reader habits can shift away from the homepage entirely. So the paper must choose: keep trying to be a generalist newspaper for everyone, or become a sharper product for a defined audience, with defined revenue logic. And that's where the incentives of the owner matter. Bezos wants profitability. The organization responds with cuts, focus, and data steering. That's not evil, it's arithmetic. Now, 3 lessons for founders and operators, and yes, for investors who care about business quality. Lesson 1. Distribution is the business model. You can have the best product in the world, but if the distribution channel changes, your economics change. Lesson 2. Trust is an asset, but it doesn't immunize you from platform risk. Trust compounds slowly. Traffic disappears quickly. Lesson 3. Metrics are a tool, not a god. Data can tell you what's consumed. It doesn't automatically tell you what builds brand equity over a decade. An operator has to choose the balance. And I'll end with the one sentence I want to land hard, because it's what this whole episode is really about. When the owner starts talking like a platform, the newsroom has to learn to operate like a business. Moving to next title, Inside Musk's AI and Space Megamerger. The lowest cost place to put AI will be space. That's not a line from a science fiction novel. That's a capital allocation thesis spoken out loud, on a public stage by the most aggressive operator of our era. And when Elon Musk says something like that, you have to listen the way a value investor listens to a founder describing a new factory. Not because you instantly believe it, but because the next sentence is always the real one. He says it will be true within 2 years, maybe 3. That's the timeline. Short, confident, almost reckless. And this is the Wall Street Journal walking us through what happened behind the curtain. While Musk was talking about orbital data centers, the groundwork was already underway for a merger of SpaceX and his artificial intelligence startup xAI, intended to make that vision real. This is not an idea. This is a deal. A corporate rewiring of 2 private giants to fund a vision that is, by any normal standard, unproven technology deployed at a vast scale. Now, I want to anchor this episode in the one thing that always matters: structure. Because stories are cheap. Structure is destiny. Within days, bankers from Morgan Stanley provided estimated valuations for both companies that could be used to structure the merger, according to people familiar with the matter and investor disclosures viewed by the Journal. SpaceX's board decided, on paper, as of January 30th, that it was worth $1 trillion. xAI's board decided it was worth $250 billion. SpaceX and xAI signed an agreement creating a $1.25 trillion company on January 31st. The deal closed 2 days later, and the Journal says that made it the biggest corporate tie-up by value in American history. 2 days. That is not a normal M&A cadence. That is what happens when control is centralized, and the buyer and seller are, in practice, one decision maker. And that takes us to the central figure. Musk is not just the founder here, he is the builder, the allocator, and, this is important, the constraint. He controls the companies, he controls the narrative, and he controls the speed, which can be an advantage in execution and a risk in governance. The Journal frames it as part of a busy year of deal-making, the combination of X and xAI, and Tesla's $2 billion investment in xAI. This SpaceX-xAI merger, they say, promises a windfall for investors in xAI. That's a very specific phrase. A windfall. It implies that the merger isn't just synergy, it's a repricing event. So why do it? The Journal gives you the operating rationale. Musk has envisioned making xAI's Grok the most popular AI in the world. But building out Grok's capabilities requires a lot of money. And for xAI, being hitched to SpaceX ahead of an initial public offering gives it more muscle to compete with OpenAI and Anthropic. Read that slowly, because it's the whole incentive package. xAI needs capital. SpaceX is approaching an IPO. So the solution is to merge them and let SpaceX's gravity, its scale, its investor base, its credibility, pull xAI into a larger orbit. But there's a cost. Longtime SpaceX investors have to make room for Musk's AI shareholders, and they face the prospect of supporting an AI company through what some believe to be a bubble, reminiscent of the dot-com boom and bust. That's the uncomfortable truth in the middle of the dream. You're stapling a capital-hungry, fast-moving AI startup onto a space and satellite business that already has its own capital intensity. Now, the inflection. Musk tells employees, in a memo, that starting launches of AI satellites is the company's immediate focus. So the merger is not just financial engineering, it's operational direction, it's telling SpaceX what it is now for. Now, here's the pattern the Journal points to. The deal gathered steam around a moment of political and capital validation. In November, Tesla investors endorsed Musk's moonshot $1 trillion pay package, the largest ever for a public company boss. Soon after that, members of his inner circle aimed at an even more audacious target, merging SpaceX and xAI. And combining them became a priority, people familiar with the deal said, given xAI's capital needs and SpaceX's coming IPO. That's the clearest explanation of all. The merger is a financing solution wrapped in a vision, and, to be fair, that's often how big strategic pivots are funded. Now, decision autopsy time, because a value investor's job is to ask, what was expected, what happened, and who paid? Start with expectations. What did Morgan Stanley provide? Valuation ranges. The Journal says at the high end, the bank suggested SpaceX could be valued as much as $1.26 trillion, far above the $800 billion valuation it targeted in a recent secondary stock sale. And xAI could be worth as much as $294 billion. Then both boards went for clean round numbers. $1 trillion for SpaceX, $250 billion for xAI. Round numbers tell you something. They signal that the valuation isn't the output of a delicate market clearing process. It's a negotiated peg that has to be good enough to get the deal done. Now, the governance point that should make any serious investor sit up. Morgan Stanley did not provide a fairness opinion on the valuations. A fairness opinion is common in some M&A deals to ensure valuations are reasonable, though less common in private-to-private transactions. Morgan Stanley declined to comment. So you have a mega merger, you have centralized control, you have round number pricing, and you have no fairness opinion. That is not inherently bad, but it shifts the burden of trust onto one person's judgment. Now, the merger blueprint. The Journal says this deal followed a pattern Musk used before, when he merged X and xAI into one company valued at an estimated $113 billion. Before that deal, X owned a stake in xAI and they did business together. That earlier transaction becomes a template. Intertwine the companies that already transact, then formalize the relationship. SpaceX was one of xAI's earliest enterprise customers. SpaceX has been scaling up internal use of Spock, a tailored version of Grok trained on SpaceX's data, according to people familiar with the matter. Last summer, SpaceX invested in xAI, while SpaceX kept up its launch schedule and expanded Starlink. Meanwhile, xAI contractors broke ground on a second data center project around Memphis, Tennessee. But executives left xAI due to concerns about management and financial health, the journal reports. And leaders from Valor Equity Partners, an investor in SpaceX, got more involved with running xAI. So you can see the operational truth beneath the merger. xAI is scaling fast and straining. And when a startup strains, the governance system either professionalizes or it breaks. This merger looks like one path to professionalization. Tie it to the stronger balance sheet, broader investor base, and the IPO runway. Now, the on-screen visuals. On-screen, the viewer sees the WSJ technology layout and a photo, a SpaceX Falcon 9 rocket carrying 29 Starlink satellites lifting off. I want you to hold that image in your mind. The bright flame, the structured plume, the rocket rising with payloads stacked inside it. That's the tangible part of the story. That is execution you can see. And the merger is trying to take that execution engine and point it at a new payload, AI satellites and ultimately orbital data centers. The journal adds another detail that's almost like a founder's Easter egg. On Jan 21, SpaceX filed documents in Nevada to create entities overseen by CFO Brett Johnson. Those entities carried the name K2, an apparent homage to the Kardashev scale, a framework about a civilization's advancement through energy usage. That's not a random code name. That's a signal about how Musk thinks. Energy, scale, civilization-level throughput. This is not increase margins by 200 basis points. This is move the frontier. Now, the hard reality check, the transfer. Some SpaceX investors believe xAI investors gained a larger stake in the combined company than they would have preferred. The journal says the transaction gives xAI investors roughly a 20% stake in the combined company. 20%. Think about what that means. If you were a SpaceX investor underwriting rockets, launch cadence, Starlink unit economics, and a path to IPO, you now own all of that. Plus, a fifth of the ownership has been effectively allocated to an AI business that requires a lot of money and is competing in a field some fear is bubble-like. This is the moment where incentives show up. Who benefits? xAI investors get a windfall. Their equity is now attached to SpaceX's mass and momentum. Who bears the new risk? SpaceX's legacy investors bear a portion of xAI's capital needs and AI cycle volatility. Now, the journal notes that on a call with investors, SpaceX representatives including CFO Johnson confirmed plans to take the company public this summer. So the IPO isn't abandoned. It's redefined. An IPO of SpaceX plus AI satellites plus xAI. Potentially a bigger one. Also, a more fragile one if the AI narrative turns. Now, what are the lessons? Lesson 1. When one founder controls the chessboard, capital allocation becomes fast and idiosyncratic. Speed is a weapon. It's also a governance risk. Lesson 2. Mergers can be a financing mechanism disguised as strategy. xAI needs money. SpaceX has a path to public markets. Combine them, and you've built a bigger vessel to carry the funding burden. Lesson 3. Compounding requires repeatable economics. Ambition requires continuous belief. SpaceX has the look of compounding when launches scale and Starlink grows. xAI has the look of ambition. Huge upside, huge ongoing capital demands. The merger is a bet that belief can finance the bridge until the economics arrive. And I'll end with the sentence that should stick, because it's the essence of the deal as described by the journal. This wasn't a merger to reduce risk. It was a merger to make a bigger bet. Now towards last article, weight loss price wars hit business models. A GLP. One prescription used to cost an uninsured patient more than $1,000 a month. Now, Novo Nordisk is starting Wegovy pills at $149 through cash pay programs. In pharmaceuticals, that kind of price collapse is almost unnatural. Drugs usually do the opposite. They climb, or they plateau, then years later, generics show up and the music changes. But in this market, the obesity market, the Wall Street Journal is telling us the rules got rewritten early. And that's why this moment matters. Because when a market rewrites its rules, It reveals the underlying incentives. Who really owns distribution? Who can set price? And whether business quality is built on patents or on access. Now, the journal frames it bluntly. Prices for GLP-1s are falling fast and forcing drug companies to adapt. And it calls out something important, something investors should circle in red. Leerink analyst David Risinger says there isn't a comparable precedent for this level of price erosion in the industry's history. No precedent, not even in other big drug categories. So this isn't a minor pricing adjustment, it's a structural shift in how the product is sold. Now, let's name the central figures and treat them like operators. You've got Novo Nordisk, Wegovy and Ozempic. You've got Eli Lilly, Zepbound and Mounjaro. And then you've got the new gatekeepers, companies that look more like consumer distribution channels than like healthcare institutions. Ro, Hims and Hers Health, telehealth portals, cash pay funnel. The journal says demand spread through TikTok, Instagram, and word of mouth, often before patients ever saw a physician. That line is a dagger into the traditional pharma model, because traditional pharma is built around doctor writes script, insurer pays, pharmacy dispenses, patient complies. Here, the sequence flips. Consumer desire appears first, demand goes viral, then the system tries to catch up. And when the system moves slowly, insurers and employers hesitating to cover the drugs, patients bypassed the system entirely, paying cash. That cash pay shift, combined with brand name shortages, opened the door for telehealth firms and compounded copycats. And with copycats comes something pharma hates, price competition years earlier than expected. So the drug makers were forced to respond. Lower prices, not because they wanted to be generous, because they needed the cash price low enough to fend off compounders and reach uninsured patients at scale. Then the journal adds another major lever. The companies later reached a deal with the Trump administration to lower prices in exchange for broader access, including Medicare coverage for millions of seniors. That is access for price, a classic trade. But here it's happening much earlier in the life cycle than we're used to seeing in blockbuster drugs. Now, let's do the decision autopsy. Decision 1. Novo's radical cash pay entry point. What was expected? A protected patent duopoly with pricing power. What happened? Cash pay became a primary battlefield, and Wegovy pills start at $149 for some patients. Opportunity cost? You give up price per unit. But you may gain volume and you may keep the category branded rather than ceding it to compounders. Hidden trade-off? Once consumers anchor to a lower price, it's hard to raise it again. You've trained the market. Decision 2. Lilly's direct-to-consumer embrace. The journal says Lilly was quicker to realize the direct-to-consumer cash pay model was the future. More than 30% of Zepbound prescriptions now flow through Lilly Direct. That's not just a distribution channel, that's vertical integration of demand capture. And Lilly is preparing to launch its own daily pill, Orforglipron, at a similar price point to Novo's $149 entry-level oral Wegovy. So Lilly isn't just defending share. It's setting the rules of the new pricing regime and building products to match that regime. Decision 3. The system's vulnerability. Compounders and telehealth. The journal says Hims and Hers announced a $49 a month compounded version of the Wegovy pill. And the market reacted. Shares of both Novo and Lilly fell sharply. Then they rebounded after the FDA chief threatened action against the mass marketing of copycat drugs. That sequence tells you the market's fear. Not that the branded drugs don't work, but that distribution plus price transparency plus shortages can break the moat faster than patent timelines imply. Now, visualize what the viewer sees. On screen, there's a chart of total market share of GLP-1s as of January 2026. Sourced to Citigroup. The bars divide the market among Mounjaro and Zepbound, Lilly drugs, Ozempic and Wegovy, Novo drugs, and others. The note says Mounjaro and Zepbound are Lilly, Ozempic and Wegovy are Novo. This is visual proof of something we already know. It's basically a two-player market with a fringe. But the chart also implies the uncomfortable truth. Even with a duopoly, the economics can look like a consumer price war if distribution fragments. Now, the journal gives a key data point on share and expectations. Lilly says it recently surpassed a 60% share of the US GLP-1 market, and it expects 2026 revenue to climb about 25% to more than $80 billion. Novo, on the other hand, is cutting prices, but volume has yet to make up the difference. Sales are expected to fall between 5 and 13%. That is not what a duopoly should look like. This is one company adapting faster and pulling away, while the other is trying to catch up in a market whose rules have shifted. Now the Roe angle, the consumerization thesis made explicit. The Journal says this past weekend's Super Bowl may codify the shift, with a talked-about ad from Roe featuring Serena Williams. Roe wants to dismantle the willpower stigma around weight loss. And Roe's CEO, Zach Raitano, says, "No one in the world has more willpower than Serena Williams." That's marketing as market expansion. Because stigma is a demand suppressor. If you remove stigma, you increase adoption. And adoption is the whole game when price is falling. This is where healthcare becomes consumer packaged goods, not in the science, in the story. Now, the reality check. Elasticity. The Journal says the key question both companies are racing to answer is how elastic consumer demand is in the obesity market. Lower prices are unlocking growth, especially in cash pay. Novo's CFO Karsten Munk-Knudsen argues it isn't a price war so much as a search for price points that open the floodgates of access. That's the language of a consumer business. Find the price that converts. Find the price that scales. And it's true. When you're moving from insurer-gated demand to cash pay demand, you are now in a world where willingness to pay is visible, immediate, and brutal. Now, what are the timeless lessons? Lesson 1. Incentives shift when the buyer shifts. When insurers are the payer, you negotiate like pharma. When consumers are the payer, you compete like retail. Lesson 2. Distribution is a moat until it isn't. LillyDirect is a moat because it captures demand and reduces dependence on slow-moving intermediaries. But telehealth and compounders are also distribution, and they can attack the moat from below. Lesson 3. Transparent prices compress returns. Pharma economics depend on opacity and negotiated rebates and long cycles. Cash pay economics are immediate. They force adaptation now, not in a decade. And I'll end with the sentence that I think this article is really trying to teach investors. In obesity drugs, the patent still matters, but access is the new moat, and price is the new weapon. This is Avi. Like and subscribe. On to the next.